Stephen Pesavento is up next, presenting two different offerings to us today. One is a multifamily equity fund, and the other one is a fixed income product. In addition to being the president of VonFinch Capital, Stephen Pesavento is also the host of a popular podcast, the Investor Mindset Podcast. Stephen, great to see you here today. Welcome to Alts Expo by WealthChannel, and thanks for your support of the show.
Perfect. Thanks so much. And I'm excited to talk with all of you guys today. My name's Stephen Pesavento. I'm the managing principal and partner at VonFinch Capital. We're a real estate private equity company based out of Denver, Colorado, with nearly a 10-year track record of buying and improving properties. So I'm going to be talking through two different opportunities today that are both available and open for investment if you're an accredited investor. The first that I'm going to spend majority of the time on is the Denver Equity Fund. It's a phenomenal opportunity that's offering, 5 to 8% cash flow and a 1.6 to 2x equity multiple, with a 2 to 3 year exit, potentially up to 5 years. The fund is set up to be a 3 to 5 year exit, but we'll be focusing on properties in the Denver metro area. And the second offering, which we're going to talk through, is a fixed income debt instrument. It's promissory notes that are backed by real estate and backed by our portfolio and our balance sheet. And those are offering either 90-day exit options or 1 to 5 year terms with an 8 to 10% fixed monthly rate of return. So we're going to be talking through both of those today. The first thing I want to get into is the Denver Equity Fund, because it's very unique. The VonFinch portfolio, which is focused on buying Denver mid-sized multifamily properties. We're based out of Denver. We've been operating Denver for quite a long time. And what we're finding in the market today is that there's a unique positioning that many of these large operators, New York funds and California funds, are coming into Denver, and they're investing and overpaying for 200 to 300 unit multifamily buildings. And that's our sweet spot. Our sweet spot had, of course, been, we started out buying mid-sized multifamily and we grew to buying, 100 to 300 unit buildings. What we found is that in the Denver market in particular, buildings that we can purchase between $3 and $15 million, we're able to get essentially at 2015 to 2019 prices. We're buying at 60 to 70% of value, 30 to 40% discount, and we're able to get very favorable terms. And so the Denver Equity Fund is focused on going out and buying those mid-sized multifamily properties and rolling them up into a portfolio that will be able to exit in 3 to 5 years to one of these larger funds. Because their limitation is they are not able to come into the market and buy these smaller properties, one, because of a scale issue, and two, because they don't have the kind of contractors and construction and property management team to be able to manage a distributed set of properties like this. But once rolled up, they're happy to write a check for $30 to $50 million. So by doing so, we're going to be able to create a lot of upside above and beyond what we're underwriting to, because those funds are willing to buy at a higher valuation. So the focus of the fund is putting together a minimum of $10 million to be able to pull together about $30 million of real estate. We have an opportunity to scale that, and we're already fairly close to kind of beating out or scaling beyond those initial projections. With the fund, we're going to be holding those assets for between 3 to 5 years. Some of them, if we have an opportunity, we may exit the portfolio much earlier than that. We want to give ourselves enough time, given we're not exactly sure when the best time to exit is going to be. We can't predict the future, but we can give ourselves a great opportunity because we're buying these at such a steep discount. We're coming in, we're doing heavy construction, and we've got an in-house construction management team that'll be managing that. So in phase 2 of the fund, the minimum investment's $50,000, and you're looking at a 20 to 30% average annual return. If we exit in 3 years, that returns closer to 30% plus. If we exit in 5 years, it's looking about a 20% plus average annual return. So we're going to get into a couple examples of properties that are already in the fund that we've already executed the construction and business plan on. And we have a number of other deals that are in the pipeline as well. So our history in business, purchased over 200 projects across the country, raised, about 50 to $60 million of equity and debt from investors just like you on this call. And we have a track record of delivering, 1.7 to 2x multiple. Very strong returns, often and always delivering above and beyond pro forma. And you can see from a couple of these images, some of the larger properties that we typically are purchasing. Although we have quite a large portfolio of smaller properties, which I'll show you in just a second. And again, my name's Stephen Pesavento. I've been doing this for nearly a decade. I've purchased over $180 million of real estate myself that I own and control, and over $56 million of real estate. Before I got into real estate, I worked in management consulting for some of the Fortune 500's biggest companies, putting together and improving processes for very large businesses. So this has been very helpful in being able to apply those skills in the construction multifamily space. And from a track record perspective, collectively between a joint venture, between our construction management and property management partner and our firm VonFinch, we've collectively purchased and renovated over 2,500 units, over $350 million of real estate. And a large portion of that real estate is in the Denver metro area. So we purchased a lot of mid-sized multifamily, some large multifamily, and we've been able to put together a pretty sizable portfolio. And so if you're not familiar, Denver is one of the strongest markets from a growth perspective. Last year, rent was over 15%. This year, CBRE is projecting rent growth above 6.2%. And part of the reason that is because Denver has so many high-skilled tech jobs, which is creating a huge demand in the multifamily space. And one of the interesting facts about Denver is that because the cost of living has gone so high on the single family side, that it's actually about 31% cheaper to rent in Denver than it is to be able to purchase. So lots of people have great jobs. People are earning a great income, but they don't quite have the income to be able to buy a $700 to $1 million home in the Denver market. So they're either renting by choice because it makes a lot of economic sense to be able to rent a property and save significant amount compared to what you'd pay for your mortgage. And on the other side, there's people that are just frankly priced out of the market. You can see this top graph is kind of showing Denver market vacancy, and it's stayed pretty consistent. Of course, this is a general overview of all property, both luxury and existing. But what's really interesting is if you look closely at this between pre-1970 to 1980s assets, the average sale price is between $227,000 per unit to about $284,000. And so that number is going to be really important as I show you a couple examples of projects that we've purchased in the pipeline just to justify the kind of discounts that we're getting. So this asset, Colfax 27, runs right on this corridor called Colfax that is the longest road in Denver. There's significant economic development. The city of Denver and the state of Colorado have committed over $1 billion towards redeveloping this area. And there's new construction all around this project. And we were able to purchase this at $111,000 a door. So again, $227,000 to $283,000, and we're buying this at essentially 50% or less of that comparable market value. And so what's really interesting is in this asset, and very similar to the other assets in the pipeline for this fund, we're getting these where rents are currently about 35% below market. So we have an opportunity to be able to come in, purchase this asset, execute construction and value add, and be able to raise rents up to market, very conservative market rents, creating about a 35% bump in income. Historically, we've been able to outperform those current market rents because we're creating a better product. But as you can see, this asset, great location right along this Colfax corridor, beautiful building, but there's an opportunity to improve. When we look inside, these are some of the nicer units. There's been some renovations. Not all of the units were this nice by any means. But as we've been able to execute construction, and this deck's a couple weeks old, we've got about 2 to 3 weeks left to complete construction on this asset. So we've redone all the exteriors, we've built new fences, and on the interior, we're adding things like subway tile backsplashes and bathrooms, resurfaced countertops, new cabinets, new flooring, new paint, all of that, which ends up leading to a much better place for people to live, and frankly, a great return. So one of the things that's really unique about this property is that at purchase, is appraised at 2 times the purchase price by the lender, which is a very conservative local credit union that understands and knows the market. So by investing into the fund, you're actually investing into assets that we've already executed the value add. We've already done the work. And therefore, you're buying into something at its original purchase price before we had done all of that renovation, all of the construction, before all the risks was taken. You're buying into something that's stabilized, and you're buying it at that original basis. And I'll tell you why in just a second. The second project that's in the fund from a case study standpoint is Ivanhoe 10. And we bought this property at about 40% below comparables, with rents about 40% below comparables. And the best part of this opportunity is that we ended up getting about 4% fixed financing for 5 years from the seller. So we're able to get this property for a steal. The value of that fixed financing is worth about $500,000 to $600,000 of value, which really brings that price per door down to, about $125 to $130 a door. This property also has a garage, been able to do some exterior upgrades. So as you can see, we bought this in February of 2023. That last property was purchased in May of 2023. Fairly decent condition, old, needs to be updated, been owned by the prior owner for over 20 years. And as a result of the construction that we executed on the property, we repainted the exteriors, just made them look, frankly, like a fresh, brand new building. The interiors, full renovation, new paint, new flooring. And in this building in particular, we were able to add washer and dryer. So what's the point of all of this? The point is that we've been able to increase rents by 34%, with those rents continuing to rise as we continue to finalize the leasing on all of those reconstructed units. And I can't underline enough the value of being able to buy into an asset that has already done all the construction. And the reason this is valuable is because when we purchase this property, we purchase it in as-is condition. But when you're investing today, you're investing in an asset that's already had the work done. The risk has already been taken. And why would we go about doing that? The reason is because in this market today, in order to be able to get deals at 30 to 40 or 50% discount, we need to have cash committed in the bank. We need that money to know that we can go to that seller and close in 15 or 30 or 45 days and not have the delay or the wonder on whether that capital is going to come in. And by doing so, we can put down large earnest money deposits from our personal bank accounts as general partners. As we're taking the risk, we have the confidence to know once we're completed with due diligence that we can go hard, and that seller is confident that we're going to close. Because here's the scenario that's happening in this mid-sized multifamily market. The seller wants to sell their property. They go to market. They go under contract with a buyer. That buyer falls through after 2 or 3 months. They go back to market. They do the same thing again. But we've consistently been in the conversation from the beginning with a price that continues to get lower the longer that we're in that conversation. And by the time that property's fallen through 1 or 2 times, we're able to not only get it at a deep discount, but we're often able to secure seller financing terms or some other type of concession that allows us to be able to create a really deep discount. And because of having that capital committed from investors like you, we're able to then move forward and create really a heck of a return for investors. And as I mentioned, we're looking at 20 to 30% projected annualized returns. When we look at the underwriting, many of these deals have return profiles that are stronger than that. But we want to set an expectation that we know we can deliver on, and a 20 to 30% return in this market is phenomenal. Being able to 2x your money in 3 to 5 years in something that you're buying that discount at purchase, so that even if the market was to go down by 20 or 30%, you've got coverage. And the best part of this opportunity for investors is the aligned incentive structure that we have. So 85% of every dollar of profit is going to you as the investor. So when you invest in this deal today, every distribution that comes, 85% of that profit is going to go to you until we double your money. And then if you're in the $1 million plus investment tier, 70% is going to go to you. If you're in the $250,000 tier, 60% of every dollar after we double your money. And if you're in the $50,000 to $250 tier, then 50% of every dollar. So that structure, what that really says is that we don't win until we double your money, because 15% of profit share working on a deal for 3 to 5 years, it's a very small share. Most operators out there are doing a 70-30 split, maybe an 80-20 split, but oftentimes there's a lot of other things that are built in. So for us, our focus is how many assets can we purchase during this window that we have where there's these phenomenal opportunities, and how can we go about executing a value add strategy that we're so confident we're going to double your money so that we can get into the profit share as well. That's the key. And so we've got a track record of results. There's a project we bought in Jacksonville, Florida. We created a 1.68 equity multiple for investors. There's another property just down the street in Denver that we purchased. We thought we were going to sell this property for $6 million when we bought it. We were very conservative on the underwriting. We ended up selling it for $9 million. So we've got a track record of being able to deliver some great returns for investors. And that's exactly what we're talking about doing here on this Denver fund. And since time's limited, I'll just jump right into the second fit opportunity that's available, and then we'll go into questions. And it's the fixed income promissory note fund that we've put together. So the whole benefit of this program is that you are going to get a fixed rate of return for whatever length of commitment that you're interested in. So if you're committing for 90 days, you commit, you want to call your money, you give us a 90-day notice, and we return your money within 90 days or potentially sooner, depending on, the cash that's available. Or if you commit to a longer 1 to 5 year term, you can get another 1% benefit of having that commitment. And so the benefit for you is that we have a track record of 156 notes that's been repaid since 2016. So we've done this program continuously. We've then launched our equity opportunities, and then we've really promoted this because in today's day and age, a lot of investors that I know are looking for a fixed rate of return. They can get consistent cash flow. So if you're getting an 8% return on $1.6 million, that's $10,000 a month. Obviously, that only continues to go up if you take advantage of some of the opportunities that are available when you invest larger amounts or with longer terms. And so one of the benefits of this fixed income note offering is that you can park your money here. And then when we have a deal that's available that you like from an equity standpoint, you can convert that equity or that note over into another opportunity. So I'm going to save a couple of minutes for questions. If you're interested in getting involved, go to vonfinch.com/Denver, and you can check out the information on the Denver Equity Fund. You can get subscribed to our list and our opportunities. Or, of course, you can set up a phone call, vonfinch.com/call. This number goes directly to our vice president of investor relations. So happy to answer some questions that have come in.
And yeah, Stephen, we did get some questions. We've got a few more minutes before we have to turn to our final presentation of the day, which will be our family office panel, investment strategies for 2023, 2024, and beyond. let's spend a few minutes going through some of these questions. The first question came in, when do you plan to pay off the debt?
Not sure which project this might be
that
for.
That question came in when you were presenting your multifamily, the Denver project.
Yeah, so that opportunity is an equity fund. So you're investing equity ownership into the projects. The terms that we have on the majority of the loans that are in that fund are 5-year fixed rate term debt. So we'll repay that debt at either exit or refinance. And the plan is to exit these properties in 3 to 5 years. So most likely based on the 4% interest rate or some of these great rates that we've been able to lock in, we'll hold on to that until it's the best time to sell in that 3 to 5 year window.
Sounds good. This question's from Steven, wants to know what types of investments are these that you're doing? Are these new construction, or do you take over good projects with developers that have run out of gas? Where do you fall along that risk return spectrum on how would you classify these?
Good question. So this is all existing multifamily built between 1960 and 1980. And the reason we're focused on that particular focus area is because they're already existing assets. We're buying them well below replacement cost. We're able to come in and do renovations with our internal construction team. And again, I failed to mention our construction and property management team is our partner on this deal. They're co-investing money, and the way that they're receiving profit is based on execution on these projects. So the construction costs on these deals are typically about 30 to 40% below what it would cost to bring in an outside construction firm, because they know that they're going to make more on the profit share on the back end by doing these deals on a low cost basis.
So just to kind of contextualize it, I don't think you would consider these opportunistic or development deals, probably like a value add strategy, kind of in the middle, maybe toward the slightly riskier end of the spectrum, but not quite as risky as opportunistic or development. Do I have that right?
It's definitely not development.
Yeah.
It's value add. There's some opportunistic characteristics.
Okay.
But I think the way that I would frame risk on these is that if we're buying them 30 to 40% below what comparables are today, and then we're able to add value that's doubling the value of the property in 12 to 18 months, we're hedging ourselves against any kind of market volatility. So there's risk in construction because of the track record. We have a 50-person staff in-house that's doing this construction. We greatly reduce that risk, and we set ourselves up for success on the exit and the takeout.
Very good. We've got 1 more minute, a couple more questions here, and then we'll move on to our next presentation. What is the loan to value? Is the acquisition fee on the asset value or the amount raised?
Yeah, so loan to value is typically in today's market between 60 and 65% or lower. We have one asset that we were able to get 70% leverage on from that credit union. That's the project that was appraised at double the value once we finish construction, and construction's essentially complete on that project.
Very good. And last question, and then I'll cut you loose, Stephen, is can you do a 1031 into any of your deals?
Yeah, so you're welcome to 1031 with VonFinch. If you have an investment over $300,000 of 1031, there is a path towards doing a 1031. You can't 1031 into the fund, into prior assets. What we do is we go out and we find you an asset or one that's going to go into the fund that we're purchasing. And you're able to come in as a tenant in common. We have a management agreement that we're able to put together and kind of help work with you. And so we've worked with a ton of folks, 1031s from, $1 million to $5 million. And we're very experienced in how to structure that for success.
Perfect. Please do visit vonfinch.com/Denver to get registered on the VonFinch platform and to request information on Stephen's fund, or you can text him or reach out all those other ways that are on the screen right there, vonfinch.com. Stephen Pesavento, great seeing you again. Great talking to you last week. Also great catching up, and we'll see you soon, I hope. Thank you for your support of today's Alts Expo event at WealthChannel. Great to see you, Stephen. Thank you.
Yeah, thanks so much for having me, and just, reach out if we can help support you with any of the things that you're looking to do when it comes to investing in real estate and private equity. So thanks, guys.
Absolutely. Well said. Thanks for your insights today.